What's going to be the economic impact of this?
I think we learned a lot from the financial crisis of 2008. I think the Fed learned a lot, which is that when you get hit with something of this nature, bold is not a vice but a virtue. And they are being incredibly bold and basically are saying we have the helicopters all ready to go, and wherever they can get them, they are going to get them, which predominantly right now is liquefying markets, and they're doing it with overwhelming force. The important thing, however, is they can't get the helicopter to land on Main Street until Congress acts to authorize essentially the Main Street funding facility. And that's the beauty of what's going on right now. I actually have a fair amount of optimism in that Secretary Mnuchin and Jay Powell are working very closely together, and they're ready to go with essentially a levered-up Main Street lending facility funded by helicopter money. And just waits essentially for Congress to say, okay. So I think we're going all in with both monetary and fiscal policy, which will stabilize the situation. It won't prevent a recession. You can't prevent a recession because this is a mandated recession or an induced coma. But what you can do is replace the income and guarantee the contracts of Main Street to get us to the other side. And I think that's what we're going to do.
Yeah, and I think you laid it out well. I mean, there's still economists on Wall Street, with all due respect to them, that are arguing about, whether we will have a recession. That's ridiculous. To your point, this is a mandated recession. The largest cities in America have basically been told, don't go out, don't spend anything unless you absolutely have to. It's going to come. The difference, though, between now and 08, Paul, as you well know, was 08, these things were designed to get people to feel a little more confident, maybe go buy a house, maybe go buy a car, allow the banks to make credit. Here, we had a great economy before in many senses, and now we're being told, don't go out. This is very different.
It is categorically different because it's not about stimulating spending. It's about replacing income that's lost because of the mandated recession. And equally important, it's about liquefying and guaranteeing contracts, whether it's financial contracts, that's called, bonds, or other contracts, so as that we, the people, can conclude that we're living in a going concern. Because we need to have replacement of income and also a belief in the going concern nature of our contracts. If we get there, then I think we've reached the bottom from the standpoint of the risk aversion on Wall Street.
When we look at what the numbers are, and we tried to put it together today a little bit, say adding up this and that, and then you throw on leverage from the Treasury, is it possible that by the end of this, if this goes on a few months or as long as we need it to go on, Paul, that we could have a $7 to $10 trillion total fiscal and monetary action?
Certainly, I think so. Essentially, the beauty of what's being done now and the cooperation between the Treasury and the Fed is the leverage. The Fed is not allowed to take credit risk. The Treasury is with the authorization of Congress. So essentially, what we're doing is having Treasury provide the equity piece into a special purpose vehicle that can be levered to the sky by the Fed. So essentially, the Fed is becoming the prime broker for Congress.
Final question, will this work?
I think it will, yes. Our economy is a going concern, and we're getting really close in the financial markets to playing it that way.